Hey everyone, welcome back to Corporate Decoder. Today we're diving into Revvity's latest financial report, and it's a bit like trying to understand a doctor's handwriting, complicated but important. Get ready for some twists and turns. This quarterly report gives us a peek under the hood, revealing how Revvity is performing and what challenges they are facing. Before we start, if you are into getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we discuss it. Revvity, a company focused on health science. This report is like a health checkup for the business, telling us if it's thriving or needs some serious care. First off, these numbers haven't been fully checked by outside auditors, so take them with a grain of salt. Let's jump into the money. Product revenue, which is basically how much they made selling stuff, hit $562.7 million the year before. That's a decent little bump, suggesting people are buying what they're selling. Service revenue, which is from things like maintenance and support, was pretty steady at around $102 million. It shows Revvity is keeping its customer relationships strong. Overall, total revenue reached $664.8 million, which is a $14 $18 Java and $80 million increase. So it's safe to say the company is doing better than last year in that regard. But hold on, the cost of making those products is still super high, around $250 million. So they are making more money, but have a very little wiggle room. What really matters is how much they made after paying for everything. That operating income jumped from $44.1 million to $72.22 million. There is a big jump. That means their changes are working. Here is some not so great news. Interest expenses nearly doubled from $9.6 million to almost $20 million. This is an expense a good CEO would keep in check. After taxes, the profit from ongoing businesses was almost $42 million. They also made some money from businesses they sold off, about $500,000. Net income is the profit they have on hand. They made over $42 million, a significant increase from $26 million the previous year. So breaking it down, they made 35 cents per share compared to 23 cents last year. Good news for shareholders. The diluted earnings per share, which takes into account other forms of shares, ended up being almost the same. But there is a catch. The part labeled Other Comprehensive Income shows a gain of almost $80 million because of changes in currency values. Last year was very different, a $48 million loss. That means their comprehensive income, the real picture of how the company did with everything factored in, jumped to almost $122 million. Let's move to their balance sheet, which is like a financial snapshot. They have cash and cash equivalents of over $1.1 billion. That is a good place to be in. People owe them over $600 million, which needs to be collected. They've got about $381 million worth of products ready to be sold. Now, on the less liquid side, they are claiming $6.5 billion for goodwill, which is a big number. That means that this number is what they see as the value of their brand and reputation. On the other side, they do not owe that much. They have around $242,000 in current long-term debt. They have to pay people over $178 million. Accrued expenses, basically, bills that are piling up, are almost $470 million. They owe long-term just over $3 billion. They also have deferred taxes that is over $750 million. That means that they get benefits or owe from TAE's previous year's tax returns. All that put together means the company's net worth, total stockholders' equity, is over $7.6 billion. Let's peek at where the money came from and went. Net income, as we said, was a strong $42. Good job. The company had a gain of around $80 million from these currency changes I told you about. They paid out almost $8.3 million in dividends. It's nice to give your shareholders a treat. They also spent around $154 million buying back their own stock. That reduces the number of shares available to trade and makes each share worth more. That is a nice flex. In the same period last year, net income was almost $26 million. One important detail is that they spent over $97 million on depreciation, the recognition of a loss on the investment, and amortization, which is basically paying off the debts, showing they are investing into keeping all their equipment working well and buying new stuff. They ended up generating $134 million in cash, but they used in other operations for about $6 million, with a net cash around $128 million. They used $16 million to buy new equipment to keep the business running. Once won $8 million to pay off promises related to acquisitions. The fluctuating exchange rates also played a big role, increasing cash, cash equivalents, and restricted cash by over $16 million. They closed out the quarter with cash, cash equivalents, and restricted cash at over $1.1 billion. That is a huge number. Revvity's report also dives into a few accounting rule changes. It is like the company is getting a new set of financial rules that affect how they present their income. They break down where their money comes from for the quarter ended March 30, 2025. It is in the Americas at over $300 million. About half of the business comes from here. They need to deliver services or goods worth $23 million. Customers have also given advance payment of almost $20 million, which they need to deliver on. Revvity sold applied food and enterprise services businesses a while ago. This sale is still generating small bits of income for them. The report is diving into how much money they're making and losing on things other than their core business, like investments and currency changes. That is a normal part of the business. They need to keep track of what is in their warehouse. Here is a neat fact. They have raw materials that are more expensive than their finished goods. That shows supply chain price increase. How much money they owe for this period. At the time, they owed over $3.1 billion in long-term debt. How the accounting works on a per share basis. Remember, they can't print money at will. They actually can issue more stock, which is like printing money. It makes the pie larger, but your slice is smaller. They report from two segments of the business, life sciences and diagnostics. Both revenue is roughly the same. These sections is how they make sure everything is still worth what they think it is. Because they operate all over the world, they try to reduce the risk on the business. Revvity tries to make sure everything is reported at its fair value for them to give a proper financial situation. Now to some possible headaches, ongoing environmental investigations. All those environmental matters are a liability of over $11 million to be resolved. The biggest thing is if people stop buying the products or find cheaper solutions, but that is the case for any business. Here is an interesting table about how the company is buying back its stocks on the stock market. Lastly, there have been changes in how some of the leadership trade their stock. They all have 10b5-1 trading arrangement, which basically sets up a plan for how they can trade stocks and cannot be accused of inside trading. Now, looking at these results more broadly, Revvity seems to be navigating a pretty complex landscape. Their revenue is inching upward and their gross profits have improved. That's the good news. A big thing for Revvity will be keeping their cost of product revenue low, interest expenses in check, and continuing on their path while managing potential impacts from environmental cleanups and legal matters. Alright, that's our breakdown of Revvity's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.